Welcome to the Trading Bell. I'm Nokip Kimboy, and today we want to paint a picture for you. We want to open the paths for you for the year 2021. What does it look when you talk matters business for the year 2021? I will be having a conversation with gentlemen from Ghengis Capital. They have a playbook for the year 2021 outlining what to expect. Well, it's better that you know of it other than be surprised by this year. Let's get into this discussion, shall we? So to jump straight into this conversation, I'm joined by the CEO of Ghengis Capital, Mr. Gerald Gangla, and also the head of research at the same investment firm. We have Mr. Chachilo. Good gentlemen, welcome to Trading Bell.
Thank you.
Thank you.
Okay. For the year 2020, we've seen the pandemic ravage most sectors of our economy. But just looking back and thinking about it, can you recap what exactly happened to the economy of Kenya in the span of the year 2020?
Thank you for having us on the program today. I think 2020 was a mixed year. Even before COVID, there were obviously certain weaknesses in the economy. I think the most pronounced being the worrying debt levels, and then COVID came, and I think it had a very disruptive effect on the market and on business. I think the government took the steps it had to take just to be able to deal with the monster. And as the experience grew, you could see that the measures sort of helped reduce the number of incidences. If you think about, people thought that our streets would be strewn with dead bodies, but that hasn't happened. The casualty rate is very unfortunate, but it's still much lower than, say, even the number of people we lose in road accidents in a year. So I think some of those early containment measures were pretty successful. I think second quarter was everyone was sitting at home and waiting for COVID to end, and then they realized COVID is not ending. So third quarter, let's get back to work. And so we saw even in our own business, quarter two, especially April, was very, very tough. But then May, June, clients started re-engaging to see, okay, what can we do in this COVID period? How are we going to position our business so that either we restructure our debt, we raise more equity, or we look at acquisitions. So the business sort of reopened. But then because of the impact on certain key sectors, education is a very big sector in our country. If you look at trade, you look at tourism, you look at generally financial services, a lot of those businesses really ground to a halt.
You've outlined how 2020 was.
Yes.
Maybe coming to Churchill, the reaction to it, because this is a global pandemic. We see at most you have the individual level, but at the personal level you're really being hit. Now we have the government level reacting to it, and we saw a number or raft of measures that were put out. Now looking back into the year, was the reaction appropriate?
Thanks, Noah. When COVID-19 hit, of course it was unprecedented. It got countries off guard, and so a number of policies were being formulated on the spur. And that also speaks to how were we, the situation that we were in when COVID-19 struck. We didn't have a fiscal room, at least to get into the large-scale fiscal stimulus policy measures that were adopted by the developed countries, be it in the US, be it in Europe, be it in some other Asian countries. Kenya, we didn't have those policies. So we did attempt to stimulate the economy by some varied measures that we had. The reduction in the CBR, the benchmark policy rate, from initially it was from 8.25% to 7.25% and then to 7%. And also the CRR, the cash reserve ratio, at least to ensure that there could be some liquidity by the banks, a reduction from 5.25% to 4.25%. That unleashed close to 35 billion of additional liquidity amongst banks. So all these efforts were meant to, one, to increase liquidity, to be extended to the private sector, which was still hurting, and also to support lending activities. But remember that we're in a point whereby it was still uncertain, even from the banks themselves where they were. They were not able to correctly price the risk premium that they are getting into. We have this novel pandemic. So in as much as the government or the CBK came into with its own monetary policy measures, it did not have the intended intended result that was being sought when it was being put in place. So that's one thing. And on the other side, on the fiscal measures, we are not able to come up with a large-scale stimulus that are being done by the other developed nations. So we had the economic stimulus package, 56.7 billion. But time and again, we still question even the viability of some of the proposals in that economic stimulus package. One of them is now the payment of pending bills. By the time the government is announcing that paying of pending bills is economic stimulus, question marks abound. That's one, and also the magnitude. We were at a point whereby the pending bills at that point was 360 billion shillings. What is 5 billion as an economic stimulus package? So all this just tells us the kind of limited space as a country that we had. Hence, I'm not even surprised by the premature reversal of some of these measures. Case in point, the COVID-19 tax measures, whereby there was that reduction in the corporate tax from 30% to 25%, the upper bracket in the individual income tax from 30% to 25%. So those have been reversed, and some other measures have been put in place. Case in point, the minimum tax. So inadequacy of addressing this COVID-19 came to the fore. And going forward is just telling us that even as we look at some of the other measures, be it on the budget, be it on how the policies that are being formulated in other spheres, we are alive to the fact that we need to be more realistic. We don't need to surpass our expectations or surpass our targets, and at some point down the road it may come to haunt us.
Definitely.
So that really came to the fore.
Yeah, so it exposed the loopholes and the red flags that we are ignoring pre-COVID-19.
Yes.
And here the pandemic isn't just putting all that in the open. Now we come to the outlook, the playbook to be specific, what you're saying for the year 2021. This particular playbook has been broken down into various segments that is easy to understand and get the full picture. And first of all, you're tackling the macroeconomic issues. Maybe starting with that, Mr. Geoffrey, what are we looking for the year 2021 macroeconomically for Kenya?
Thank you. 2021 will undoubtedly still be a challenging year. Our house view is real GDP growth of about 5%. We see a much quicker recovery to the GDP situation with the continued opening up of the economy, the possibility of vaccines being available in the next few weeks, and the fact that I think there's a realization that we just have to get up and get on with it. If you look at even just the overall performance of the NSE, maybe you can say, look, the market dipped 30% or so. But then in there are also pockets of value for investors. So some investors have had a year where they've done quite well financially by deploying different strategies. So the fact that the macroeconomic environment may be challenging doesn't necessarily mean that it's all doom and gloom for investors. And I think that's the message which we wanted to bring out. I think the biggest challenge probably from a government point of view is the fact that there's been a lot of disruption in the economy. So Kenyans out of meaningful work. And if you look, we have a workforce of, 20 million people, slightly more. And just about 10 to 15% are in the formal sector. The rest are in the informal sector. So I think that's where probably the biggest COVID burden is in terms of lives and livelihoods and the economic activity that these people undertake. So measures to support that sector are quite critical. If you look, we don't have much headroom in the fiscal side because we've been running a budget deficit, and past pronouncements of fiscal consolidation have not really come to bear. I think we saw a certain trend beginning of 2019 and the ratios kept improving, but then 2020 everything has sort of been blown out of water. So we're seeing a very tough fiscal environment. Revenue collections have gone down tremendously, and the expenses are pretty much still the same. So I think one of the biggest challenges for government is there a way around the expenses? Companies have had to make very painful decisions to just survive COVID. But I think with government, that hasn't been the case. And you see in the squeeze they're in, that has to really come to the fore.
You've raised a very important and pertinent question. What will we do at the end of the day? Because we know the problems. And Churchill, I want to come to you because we've seen the way government has been reacting. The pre-COVID tax rates, for example, just take that one for an example. Then we went through that deep. There were some reliefs. Of course, you hinted that, its impact, we cannot really gauge, and also it didn't really touch on the informal sector, which touches on majority of lives in this country. So for the year 2021, what will be what are you forcing the government to do directly to at least turn this ship around?
Thanks, Noah, for the question. Already what is out there is now the expected post-COVID economic recovery strategy. It was initially, the draft version of that came around early November, but we are thinking that it might be announced now sooner. So the specifics of that will be there. Just to take you back, there are a number of some issues that even the government has tried to address. COVID-19 came last year, and then amongst even the economic stimulus package, there was that national hygiene program, the Kazimtani, which was intending to employ 200,000 people. But just looking at the specifics around it, you are seeing that the budget is around 10 billion shillings, 200,000 people to be employed, and you're looking at a time frame of 1 year. So just drilling and getting into the math, it's a hard reality. It could work out to around 4,000 shillings per month to people getting into the Kazimtani program. So it's the feasibility of some of these projects are in doubt. So I'm really keen at looking at what will be in this part of the post-COVID economic recovery strategy. What Jeff mentioned earlier, now that we are benefiting from the debt service suspension initiative, so far from the 10 Paris Club creditor nations, we are looking at close to 33 billion shillings. And what means from out of these savings, which we are meant to have paid between 1st of January up until 30th of June, we are meant now to somehow ring fence it and now spend towards the health crisis or the social crisis or the economic crisis that has come as a result of COVID-19. And obviously, there could be a monitoring mechanism by IMF, at least to look at the viability of these funds.
Definitely, and we'll wait for, the finalization of the economic recovery strategy and see how feasible, as he puts it. Because some of the measures they sound so good, but you dig into it, there's a little bit of, it doesn't add up. So we'll look to that. Then the second outlook that, this particular playbook issued for the year 2021 was the fixed income outlook. So in this category, what are we talking about, Mr. Joffrey?
Firstly, I think we've seen overall the fixed income market, and here I'm looking more at the domestic Kenya shilling bond, has been pretty active.
Yes.
In fact, I think when banks sort of reduced lending in the COVID period, a lot of money started moving into the government security. So overall, the yields have compressed quite a bit. And government has also been taking in a lot of money from the markets, which also points to the fact that there's huge need. And also the target for the debt raising in each year, I think, has been increasing. So they start the year and then they see the strong appetite and they keep increasing. And I think we're looking at almost 600 billion for this fiscal year. Before we're looking at figures of around 450. So maybe good for government funding, but I think it's worrying from a broader economy if the long-term money providers are only going to put money in government securities and not support the other productive sectors of the economy.
Definitely. Yeah. And for a normal mwananchi, you can't compete with the government. Yeah. So access to credit, especially to the MSME sectors, that has been a conversation that we've had even pre-COVID-19. And, we're speaking about stimulating growth, productivity in the country. Is there an approach, or what could be done, Churchill, to make sure that there is this vibrance and banks becoming a little less risk averse, because MSMEs are quite risky, but seeing more, injection of capital and credit into the MSME sector?
Yes, definitely. That will be a step in the right direction to bring on board the MSME segment into the credit mediation bracket. Right now, there's a SME credit guarantee scheme, which was launched last month. This is now the partnership between the government and 7 banks, at least, to ensure that it gives even the banks that confidence that when they are lending to an SME with this SME guarantee scheme, which is acting like a backstop, in the event that there's a failure by the SMEs, now Treasury might come in and support in terms of repaying. So that's the whole rationale about this guarantee scheme. But that said, just circling back to the banks themselves, they're not been able to price or premium in the current environment. We have COVID-19. On the other side, we have this close to 50% of the people who had taken loans earlier, be it individuals, be it businesses, asking for a restructuring, be it the maturity of their loans, or be it even the interest payments that they are paying one way or another last year. And it's a bit, it doesn't have a compelling case that right now that that they might even have a robust credit mediation to the SME segment. The thing that we are saying that might unlock this issue is now if banks, their request for a risk-based pricing model is approved. When the interest rate capping was there, it limited even the banks themselves to price credit. Everything was now bunched together, CBR plus some basis points above that across the board. So you as Noah, me as Churchill, we might have different risk profiles, but we are having the same we are bunched together.
Wow. And lastly, because this is quite an interesting conversation, you can go for edges, but matters equities outlook. We saw ABSA, their report on the financial markets for Africa, comparing these countries, and one of Kenya, we dropped in that listing compared to the previous year. But one of the talking points was the depth for our markets, yeah? And talking about the equities outlook, just break it down, Mr. Geoffrey. First of all, the issue of banks being very dominant in capital's market. How is that impacting, and should we be expecting to see a change in this issue of taking the markets a little bit deeper?
Thank you, and that's a very good question. If you look at in a way, our market valuations for companies is also driven by the performance of the particular companies. There's a very clear relationship, and if you look at the profit pool of the commercial banks, is significantly higher than most of the other manufacturing industries, and I think banking assets are probably in the couple of trillion shillings. So banking has grown to be a very big sector here. So it's not a surprise that that will be replicated in the capital market. In just the same way, Safaricom is very much today easily 50% of the market. So look at the earnings, look at the dividend. I mean, revenues of 250 billion shillings. I mean, it's not insignificant. So what is critical is to look at the relative valuations. And if you see our report, we've gone heavy on the banks. If you look at most banks trading at price to earnings of about between 5 and 7. That means basically if I bought a banking share today, within 5 to 7 years I'd have recouped my money, even if the earnings stay the same. So that's why it's important to look at that. And if you look at the market average, it's probably about 10 times. So we are seeing that a lot of the banks are significantly undervalued. Probably the more undervalued counter today. And most banks, especially the listed ones, have a good track record of earnings growth and of dividend payouts. And these are really the things that excite investors, because when I invest my money in equities, I want a return. My return will only come in the form of dividend and in the capital appreciation. And capital appreciation is largely driven by how quickly your earnings grow. So it is not a surprise that Safaricom, because of the consistent 10 to 15% growth in earnings, the market value has consistently gone up.
All right.
So I think the challenge is really for the other companies to really come up with strategies that would ensure that they make a bigger dent in and have a good earning story. So in many international markets, insurance companies tend to be another very big sector. But if you look at our industry, insurance is probably still a lot smaller. Very few of them are even generating $1 billion in profit. Yeah.
Definitely. And Churchill, the issue of IPOing as we close up this conversation. We've seen the, Ibuka program they take in and hopefully leading to an IPO. We saw this with Homeboys. That process, from your analysis, is it seamless? What can it be done? What could be done to see more IPOs?
Yes. The market is quite looking for fresh listings in the market. Looking at in any given day, you'll find just the top 5 counters being traded. That's Safaricom, KCB, Equity, EABL, and probably Kenyan or BAT, Kenya. So there's that element of increasing the investable securities in the market. We've seen more of the listings in the market over the last 2-3 years, as opposed to now new listings in the market. And that NSC is trying to address by the Ibuka program, the incubator and accelerator program, for some of these potential names to be listed in the market. Homeboys has jumped, now come into the gem segment. Looking forward to who will be the next candidate.
Definitely, and that is quite a positive outlook that you have for the year 2021.
Yes.
You know, from reading the document, we can sense that feeling of, you know, getting a vaccine. Yeah, there's some element of hope as we walk into the year. Let's hope that it pans out to be that way. This is just the tip of the conversation. You want to get to the meat? Well, go to Ghengis website, also across their social media platforms. You'll get this report. Sit down, read it, dissect, get it into your veins, and understand what 2021 looks out for you, for your business, and for your portfolio. Well, at this particular moment, we want to take a look at the numbers. On this particular point, we have to put a full stop to the show. Thank you very much for watching the Trading Bell. I'm Noah Kipkemboy. See you next time.